Hi, this is Chris Abrams, and I just wanted to make a quick video just to compare the life insurance policy for the child compared to three other options for putting money away to save for the child's future. So this is called our wealth report. It's a 22-page document that will show all the numbers, the income in retirement, when the income ends, death benefit, and expenses between a life insurance policy and three other options. So these four columns here on the left in green, this is our index universal life policy on the 2-year-old child. The two red columns here are a taxable account, which would be like a trading account or stock market account. The blue columns here are for a tax-deferred account, and that would be like a 401k or IRA. And the last two columns in purple are a tax-exempt account, which would be like a Roth IRA. And we're keeping all the parameters the same. Expense is 1.5% on all these. The expenses are included in our numbers here in the life insurance policy. And we're using 6.5% as growth in all four accounts as well. So the first thing to notice, this age 3, so this is for the 2-year-old after the first year, and here's our premium of $900 a year or $75 per month going into each vehicle. So one thing to notice off the bat is that just in case something, the unthinkable happened, the death benefit for life insurance policy is $134,606. That would pay out if something really horrible happened. On the taxable account and these other accounts, you just get about $900 in change back. If anything happened to the child. But let's go out a little bit further here into the future, and let's look at age 35. So at age 35, we've been saving this $900 a year. And the thing to note is that our death benefit has grown to $245,000 in the life insurance policy. We have $78,000 of cash here in the policy. And if we look at our taxable account, we've got $52,000 in cash, $74,000 in our IRA. There's technically $103,000, but remember we've got to pay taxes on that. So at a 28% tax bracket, we would only have $74,000 in cash, and the tax-free account would be the same with $74,000 in cash. Now let's go out all the way to age 65. So in this hypothetical example, we are putting $75 a month away. When the child is old enough, maybe they graduate college and start working, we'll change ownership of the policy to them, and then they keep funding the $75 a month all the way to age 65. So at age 65, in our life insurance policy, we've got $663,000 of cash, and the death benefit has grown to almost $800,000 here that would be payable to the heirs if something happened. What's important to note about this is that if there was ever an accident or an illness and the child couldn't qualify for life insurance later in life, well, because you started this policy when they were 2 years old and healthy, they've already got this life insurance and death benefit in place for the rest of their life. So it's a great thing to have in place for a child just in case. So at age 65, if we go over here, our taxable account has grown to $175,000. In our IRA or 401k, there's $373,000 after taxes, and the same amount in the tax-free account. Now here's where it gets really interesting. Let's say that after age 65, at age 66, your child wants to take out a tax-free income out of these accounts. So out of the life insurance policy, and this is a very conservative estimate, but they can pull out $56,000 per year tax-free. You see that this goes all the way down here. As they get older, they can still pull out that money. Now on the taxable account, if they start pulling out the same amount, the $56,000, it only lasts for about 3 years, and then when they're 69, they actually run out of money. So this account is out of money before age 70. On the tax deferred side, or like an IRA, they pull out the same amount, and they've got to pull out $77,000 because remember, in a IRA or 401k, you've got to pay tax on this money. So this $77,000 would be equivalent to $56,000, just to make the numbers even. And in this account, they run out of money at age 73, and then there's no more money left. On the tax-free side, they pull out this $56,000, and again, they also run out of money at age 73. So the important thing to note here is because of the way life insurance is structured, and we can pull loans out and basically still earn money or still earn interest on the money that we take out of our life insurance policy, the income will last much longer from the life insurance side than it does from these other options. So if we go all the way out to, let's say here to age 95, so we've pulled out 1.6, or your child has pulled out 1.68 million tax-free out of their life insurance policy, and there's still a death benefit of $552,000 that would be paid to their heirs. On the taxable account, we've only pulled out $181,000. $607 came out of the 401k, and $437 came out of our Roth account. So as you can see, you get much more money out of your life insurance policy than you do these other types of assets. Now, another thing that comes up that I hear a lot, it's a big myth out there, is that life insurance is expensive. So let's look at the cost comparison between life insurance and then these other options. So what this is this page is the total expenses and taxes paid on the life insurance versus the other options. So if we look at after the first year, in the life insurance policy, yeah, we paid about $295 in fees. So it's definitely more expensive. And the way life insurance is structured is for the first 5-6 years or so, depending on someone's age, you'll pay a lot higher charges on life insurance than other options. But remember, this is a long-term contract that your child will have for, could be 90 years or more, depending on how long they live. And after year 10, life insurance will be less expensive than the other options. So I'll show you how that works. But year one, $295 in expenses versus, only $31, $20, or $14. And this is just a 1.5% expense on these other accounts, except on the taxable account. Remember, we've got to pay taxes on our earnings, so you pay a little bit more in this account because we're paying taxes now. Now let's go a little bit out into the future. Let's go all the way out. Let's just pick age 32. So by age 32, you'll see here that the expenses in the life insurance side, or life insurance policy, are $7,805. On our taxable account, between the taxes and fees, we paid $19,000. On our 401k, we paid $15,698,000 in taxes and $11,000 on our Roth. So as you can see here already, the life insurance policy is quite a bit less expensive than these other options. And if we go all the way, let's go all the way a little bit further here. Let's go all the way out to age 82. And you'll see here that on the life insurance policy, we've paid $61,000 in fees. On our taxable account, even though this ran out, remember, all the way here by age 69, we've paid $136,000, or double the amount of fees. And what's super expensive is if we had a 401k or IRA, between taxes and fees, we've paid $342,000. So it's a big thing to remember when if you're putting all of your money into your 401k or IRA, remember that when you pull that money out in retirement, you're going to pay taxes on all the money you put in plus all of your earnings. So it's a huge tax hit relative to other investments. And if we look at our Roth, we've paid $124,000 in fees on here, so double what we paid in our life insurance. So that's kind of a good comparison between life insurance and three other options for savings. And as always, this can be used on your kids as well as grandchildren, and we specialize in setting up these types of policies for our clients. So any questions at all, please reach out and we'll be happy to help. Thank you.